Most people rely on one type of income, their job. Wealthy people have 7 or more income streams. If you don't know what those 7 streams are, you're leaving money on the table. Let's break down every way money generates more money. Income type 1, interest income. This is when you lend money and get paid for it. Savings accounts, bonds, CDs, treasury bills all pay interest. In 2026, a high-yield savings pays about 4.5%. A 10-year treasury bond pays around 4.3%. If you have $100,000 in bonds, that's $4,300 a year. The downside? Interest is taxed as ordinary income at your full rate, up to 37% federally. Stable and safe, but not tax efficient. Income type 2. Dividend income. When you own stocks, some companies pay you profits every quarter. If you own $100,000 in SCHD, you'll receive about $3,500 annually. The beautiful part? Qualified dividends are taxed at 0, 15, or 20%, much lower than ordinary income. Non-qualified dividends, like from REITs, are taxed at your regular rate. Income type 3. Capital gains. This is profit from selling an asset for more than you paid. Buy stock at 50, sell at 75, you have $25 per share gain. Short-term gains, held under a year, taxed as ordinary income. Long-term gains, over a year, get preferential 15 or 20% rate. This is why buy and hold investing is tax efficient. Income type 4. Rental income. Own real estate and rent it out, that monthly rent is income. Let's say your property brings $2,000 a month. Mortgage, taxes, insurance, maintenance cost $1,500. You cash flow $500 monthly, $6,000 yearly. The IRS lets you deduct expenses and depreciation, a paper loss reducing taxable income. Real estate is one of the most tax-advantaged streams. Income type 5. Royalty income. Create something once, get paid forever. Write a book, earn royalties on every sale. Create a song, earn when it's streamed. Invent a product, license it, collect royalties. The best part? Royalties are passive. Do work once up front. It pays for years, sometimes decades. Income type 6. Business income. Active income from running a business. Freelance graphic designer earning $5,000 monthly, consulting business making $20,000, e-commerce doing $50,000 revenue. Business income has highest earning potential because there's no ceiling, but it requires active effort. Stop working, income stops. Income type 7. Capital appreciation. The increase in value of assets you haven't sold, also called unrealized gains. Your house appreciates from $300,000 to $400,000. That's $100,000 appreciation. Stock portfolio grows $50,000 to $80,000. That's $30,000 appreciation. The beautiful part? You pay 0 taxes until you sell. Unrealized gains build wealth without triggering tax bills. Billionaires use this to stay rich, borrowing against appreciated assets instead of selling. Which should you prioritize? In your 20s and 30s, focus on business income and capital gains. Build side hustles, invest in growth stocks. In 40s and 50s, add dividend and rental income for cash flow. In 60s and beyond, focus on interest and dividends for stability. The goal is multiple streams by retirement. One fails, 6 others keep you afloat. Here's your action step. Identify which streams you currently have. Most people have 1 or 2. Pick one new stream to build this year. Start a dividend portfolio. Buy your first rental. Create a digital product. Diversify your income. Subscribe for more wealth-building strategies every Tuesday and Friday.